All right. Hey, everybody. Welcome back. We've got our next meeting for the book club where we're going over the psychology of money. And today we're going to be talking through chapters 10 and 11, which, like I've said this before, but I feel like the next chapter is always the best chapter, or maybe it's just recency. But in chapter 10, it talked all about saving money and some different ideals and parameters around that, which I thought a lot of them hit home, at least for me. But I do love the little tagline he's got at the start of the chapter that says the only factor you can control generates one of the only things that matters. How wonderful! So I like that because I think it is pertinent here. But we'll dive in, and basically what we did here to go through it was tackle each one of the main bullet points. But love to get some feedback on what parts stuck out to you. So this was the first one. He talks about page 103. Building wealth has little to do with your income or investment returns, but lots to do with your savings rates. That's the theme today. So be curious what y'all thought about this and anything that might have stuck out.
Yeah, I loved this chapter. I think this is so good to hear. Right? It's like it's not about the returns, right? It's not about finding the GameStop stock or whatever it is that's going to give you that immediate pop, right? It's about the discipline and the savings rate. And one of the things I struggle with personally is like, okay, how much are you saving to kind of build up wealth versus how much do you want to kind of enjoy your life, and what's that right balance, right? Because at some point you're going to save up all this money and then you die, and then it's like, what do you do with it? So do you want to get to a point where like you end your life at zero so that you can kind of, that would be like the maximum, right? Like the max, you kind of spent it all and then it's like zero, so then you're like, okay, great, I'm done, I'm dead. But then it's like, but you can't predict when that is. And so, how much do you want to save? And do you get in, can you get into a trap where then it just becomes about saving and you save up all this money that you have nothing to do with it?
Yeah, the answer is yes for some people, for sure.
Hmm.
And that is always kind of depending on the person and what they aspire to do with their money. It's always like if you could optimize it, then theoretically you would, like, on your deathbed you'd have zero. But we all know that life doesn't work that way. There's too many variables that come into play: savings rates, returns, spending, life expectancy.
When you're gonna die, I mean,
Yeah,
Mm-hmm.
and then ending at zero might mean that then there's still whatever portion left over that you do want to give to your heirs. So do you earmark that separately, or how does that work? But
Mm-hmm.
really good way of thinking about it, because that is one of the most common planning type questions that we try to help people answer. Both through their own exploration. Well, what do you want to have happen?
Yeah.
What do you want to be able to spend, and what do you want the end to theoretically look like?
Yeah. One of the things I was reading, and I'm reading another book um, that just really thought it made me think about this, where, you know, um, these two kids, their mom had kind of left them, and then their dad passed away when they were in their young 20s, right? And the dad had remarried and had changed like the will and everything to give all the money to the new wife. And so the kids had nothing and they got kicked out, and then they were like so upset, right? And I was kind of like, what is the expectation, right, that you pass on to your kids? Because I was kind of like, we should all feel like we don't need to get inheritance, right? But it seems like that's so much ingrained in Western culture that you're going to get something when your parents pass away. And that, a lot of people's wealth is actually built not upon their own wealth, but on previous generations' wealth. And it's like, is that something that people think about when they save? Is, because for me, it's like, I just want to get to zero, right? I don't feel like I need to have millions when I die to be able to pass it on. I'm hoping that I can raise kids that are going to be self-sufficient and be able to live on their own. But I'm curious if when you guys have your conversations with folks that are planning, are they always thinking about building up huge nest eggs to pass it on to future generations?
the answer to that is I mean, are they always? I wouldn't say always. Most of it just falls in different. It also depends on your level of wealth, right? There's a certain point of wealth that some of our clients have that there's going to be millions and millions left over, right? There's just no way to spend the money. So then it's, well, what's important to you to do with it? Do you want it to go to all your kids? I mean, do you want your kids to have $20 million, each so that they have it? Do you want it to go to charity? And what does it mean if you were to just give someone that kind of money, and inherited that kind of money? I mean, we see it a lot, from our clients, right? Because our clients are kind of, in the from my age to mid 60s, right? And the clients are planning on receiving an inheritance from their, sometimes from their parents, and thinking, that's calculating that into their retirement. And also, sometimes when they do that, it's thinking, well, you don't really know that, right? If you're not intricately involved and your parents, you assume, are real rich, right? But in reality, they were living a very nice life and they were spending a lot.
Yeah.
If you're 60 and or let's say you're 50 and your parents, both your parents are alive and relatively healthy and 75 or 80, you're talking, that's a long time off for them to be spending that money. Is there what's really going to be left? Is there actually going to be a big inheritance? Is that something we should factor into your own retirement? I mean, I think it's very personal, like each their own of how they feel about their money going to kids, going to charity, going to, whatever it may be, or giving it away during their lives. I mean, some people can afford that, right? The example I gave with $20 million, I mean, they don't need to wait till they die to give money out. I mean, there's plenty, they don't have to worry about spending it. As to where someone with, obviously a substantially smaller portion who, feels like they have enough, but you never really know, is, going to have to wait, and then it's up to them what they want to do. And it's like you said, hopefully, truly, your kid, when I hope if I ever inherit money, from my parents, I mean, I'm already retired. Right? I mean,
Yeah.
hopefully. Yeah.
Yeah. No, it made me think about like, I appreciate Morgan's, I appreciate, right? Money gives you options. And I wholeheartedly believe that, right? Like I'm about to quit my job and, be unemployed for a while because I've got enough money to make me feel like I've got that option to do that. I don't have to work if I don't want to, at least for a little bit. But I also think about too, like, can you get so focused on saving money that then that becomes the game, right? It's about building the money, and that, then you sacrifice maybe not sacrifice happiness, but then you're not like living your life to where you could have lived it.
Mm-hmm.
Yeah, absolutely. I mean, there's some people where, money truly is the motivation, right? Where it's like there will never be enough. Thinking back to one of the previous chapters, it's always just about, well, I just want to have more just because, not because I'll ever spend it or because I want to or need to, just because, my mindset is I just need to have more money at, not always at whatever cost, but at the expense of other things potentially. Yeah.
Yep.
And we don't see
it's just a lot of that is personality type.
Yeah, personality. Yep.
We don't see as much of that with the type of people that we work with and who kind of we're more organically attracted to. But it's certainly out there. And like Kenny was saying, it really depends on personality type a lot.
Right. I mean, to me, I like, money gives me obviously any flexibility and the ability to have experiences that, it can hopefully are memories you take with you for the rest of your life.
Yep.
And it take care of my family. Mm-hmm. Some are what we would say refer to as accumulators, which is what you kind of just said. I want to have money for money's sake. It's just for whatever reason in their psychology that makes them feel good. The others are the money gives me this status. I'm looked at, it's more ego, like we would call that a mogul, thinking that, I think he gave the example of the guy who drove the Porsche, he had to give it back, but he's like, everybody assumed he was rich because he had this, Porsche, and people were looking at the car. I mean, I take, like, my main takeaway from this chapter is you're focusing on what you can control. And like, that's where,
Yep.
the example I think he gives right at the beginning about the, energy consumption in the United States, right? We couldn't just hope, oh, we'll just find more of it. Oh, I'm not saving enough, I'll just earn a better return, hopefully, but you can't control that. You can control, what you're saving, what you're putting away. That has direct impact and 100% guaranteed success of, building wealth. So where investing is totally out of our control, more or less. And that's really what everyone wants to focus on.
Yep. What's the return? Yeah. What's going to get me? Yep.
Right. No, I mean, the points that Kenny's making are on this slide, but what you just said, I'll jump back to this one, the bottom part. He gives the example of some people are, professional advisors, but they will grind with everything they got to get that little incremental sliver, or hope to, when in reality, they could easily change some other thing that would provide 20 to 30 times that little incremental return that they're in search of. And I think that that's really powerful to understand. But yeah, I mean, here on this slide, we're talking about, the income and ego, how that relates to savings. And then, what are you in control of? Determining what brings you happiness. For a lot of the people that we just naturally are attracted to, or that we work with, it's all about, hey, money serves my family's purpose. That's what it's all about. That comes in different ways, but that's really the underlying theme behind everything that they're working towards.
Yep.
From a personality perspective.
Yeah. No, and I know I brought this up in previous chapters. I mean, I think that whole happiness thing is such an interesting concept. And I was mentioning the Yale online course, The Science of Happiness, right? Where people think, material possessions is what's going to make them happy. And actually you do get a little bit of a bump, but after that you get used to it, like a new car, a new house, a new, designer wardrobe, and you go back down to baseline. And so I think it's also just kind of working with that, that mentality of like buying all this stuff, make you happy for a second, but after that you're back to baseline. You got to keep buying. And so it's not on money to make you happy.
Right, because the shine quickly wears off. I don't care what it is. If it's the smallest, most inconsequential thing, or if it's quite literally the shiny new car, the shine always wears off very quickly. And then you're either just bored with it or tired of it, or you're in search of the next shine, even more shiny. Yeah.
It's just like, I mean, I think of it, in some ways it's like, this is probably to the extreme, but like a drug addict is really, it can make you feel good for an instant, for a short period, but you're always going to be chasing that. And it's never going to give you true happiness, and being, happiness to me, meaning content and satisfied with where you are. And if that's what you're counting on money to do, you're going the wrong way.
Right. Find that meaning or purpose elsewhere. This was one of the points that that I really gave some thought to, because I mean, what he's saying is so true. You don't need a specific reason to save, but I think it's so counterintuitive to what most people's initial response to that would be. From a behavioral perspective, it's like, well, if I don't have something to save for, it's not that I shouldn't, but then it just becomes much harder to save, I would say. Like if you know that you're working towards a down payment on a house, or if you know that you're saving for college or the vacation you've always wanted to take, whatever it might be, then you can say, okay, I'm making progress towards, let's say, a more tangible goal. But then the follow-up, I think, is really important to that. The reason that you're saving is this hedge against the inevitable and the unexpected and the surprises in life. That is really where savings become most helpful to you, or could be most detrimental, because they can either, the savings can either give you the flexibility, the opportunity, the time, or it can't.
Yeah.
And you don't really know that until you are going through it or experiencing it.
Yeah. And I think we're seeing a lot of that with COVID right now, with people that live paycheck to paycheck and unfortunately are losing their jobs, right? And not having that safety net, not having that ability to kind of keep you afloat for a little bit while you're still looking for new opportunities. I mean, that's like my worst fear is not having that.
Yeah.
Mhm.
I would say if this is like the one piece of this chapter that I could drive home to everybody that I know, it would probably be this, because it's like we're saving for the future unknown. That's
Yeah.
what it's great to have goals. We talk with our clients a lot about goals, but it really is much more than that.
Yeah, that's really interesting because like when people say, "Oh, you should be saving," it's always like, "Oh, you should be saving for retirement." It's never around this kind of messaging of like, "No, you're just saving so that, for a situation where unfortunately things don't work out and being able to have something to fall back on." I
Mhm.
think that is a really important message.
Mhm.
Yes, I agree. It's saving uh, for the unknown, right? I mean, it can be for retirement in your mind today, but giving yourself that cushion of for the unforeseen happens. The only person who would say I don't need to save is one who could tell you exactly the future,
Mhm.
right? And as we all know, nobody knows that. So something unpredictable will happen, and it may require you to have substantial amount put away. And it's not not something unpredictable will happen. Now, whether or not it requires you to have substantial amount is just unknown. But if you do, you will be a much happier person that you did. And that's why you just got to put money away, because you don't know what can happen. And all you got to do to prove yourself that is look back at your own life 3, 4, 5 years ago. Everybody, it's different than you would have thought it was going to be 100%. Maybe some of us are closer to the path that we thought. Some are going to be more varied, but it's never exactly as you laid out. And if it did end up there, it got there in a different way.
Mhm.
Mhm.
It is so true, the cliche that literally when you wake up in the morning, you don't know if that day is going to be the one that changes your course dramatically for the course of your life. It could be any given day that you wake up.
Mhm.
It's true.
But personally, financially, professionally, your career, whatever it might be, you never know if that opportunity is going to be there, or if that drastic, unforeseen event is going to be right in front of you.
Yep.
Yeah. Good. So yeah, again, talking about the flexibility, um, it's hard to calculate what we tend to overlook, but there's that hidden return. And then he goes on to say, and that hidden return is becoming more and more important. And he gets into the conversation about, you know, we've long known that we're in the information age. I mean, you hold up, you grab your cell phone, your computer, you can get any bit of information anywhere, anytime. So we've known that, but then he's taking it one step further, that even just being smart isn't necessarily as much of a differentiator as it once was.
Right.
You got to take the information. Now you got to be smart, but then you've got to be able to ultimately add value. And you can do that by having the flexibility to make those decisions like we were talking about previously. So yeah, no, I thought that this was a really fascinating chapter, because I think it applies to a lot of people, and in particular a lot of our clients, given where they are in their lives and what they're trying to accomplish.
Mm-hmm.
Yeah. I mean, the thing to me that made me feel better too, it's like, don't even really stress about like, what mutual funds you're in and like what stocks you're in, right? Because that's not what's the bigger determinator. It's like just make sure you're consistently saving every month and it's just, automatic, and that's going to make the bigger difference. I mean, it goes back to the Warren Buffett thing, right? Like Warren Buffett had like 80 years of being in the market or whatever it is. Like that's where his wealth is from.
Yeah.
It's not always about like, oh, I bought this stock when it was at this point. It's like that's all just noise. And in the end, it's like it doesn't matter. That's not what is gonna generate the wealth.
Right. Well, moving to chapter 11, I can't tell if you're being reasonable or rational right now, Morley.
Good point.
Perfect segue.
Yeah.
Uh,
I thought this was an excellent chapter too, and just gives very practical advice about how you're handling, your own money and your own investments and what's going to give you the best chance of success. And I don't know, I don't know if it was in this chapter or the last chapter about, what Morley just mentioned, be staying invested, right? That's the determination of whether or not you're going to have a good return over any 20-year period. There's never been a negative return. And if you have a I mean, I don't want to jump too far ahead, I guess, but if you have, sitting aside enough cash that you don't care what happens in the up and downs of the market, you're
Yep.
going to end up happy. I mean, we tell clients this all the time. If you come in here and tell me you're a conservative investor today, and in 10, 15, 20 years from now, we look at your portfolio and you're still a conservative investor, you're going to be most likely very happy with your end result for the amount we're handling. And if you tell me you're aggressive today and we look back and we look forward in 20 years, you remain aggressive, you'll probably be even happier with the end result, but you'll be more wild swings along the line. The only way we can't assure if you'll be happy or not is if you're conservative today, you're aggressive in 5 years, you're more conservative in 7 years, and you're jumping all around because you're not able to remain either reasonable or rational with your portfolio.
Yeah.
That's how you end up with a bad return. Not because the market's going to have a bad return. It's
Yeah.
the human emotion that's driving your decisions. And so that's where, mathematically speaking, he gives the example, of leveraging your portfolio 2-to-1 in early years, and just the odds are you'll have way more money by doing that. But the likelihood of anybody being able to implement that strategy and stick with it is slim and none. I mean, it's just not really possible. So yeah, mathematically, that's probably gives you the highest expected rate of return.
Mm-hmm.
But emotionally, it can't be handled. So it's just not practical.
Yeah. It was tempting though. It was tempting to try it. I mean, I wouldn't do it as my primary savings, right? But to see like where that would end up, vis-a-vis like a well-diversified portfolio where you're just, continuing to put stuff in it. I mean, that was really intriguing.
Mm-hmm.
I think
I
so.
agree. I mean, you have to be, to a certain extent, and this is why this is what allows like an advisor to handle it for someone else typically better than they can handle it themselves, because I'm not as emotional about your money as you would be about your own money. So we can have a strategy and stick to it because we believe in that strategy wholeheartedly, as to where, and we understand what entails, what risk and up and down, as to where if you're doing it your own, yourself, you are emotionally attached 100% to that. And it's just tough to be completely, stone-faced and emotionless when dealing with your money, because it is an emotional topic. It just affects too much.
Yeah. And I thought that, I mean, that plays into really me kind of reevaluating what I think of as risk, because we talk about risk all the time, not every single client meeting, but many of them. But I thought this was a good way of looking at it. The risk is really, what are the odds that you'll walk away, that you'll pull the plug, so to speak. And he gives some examples like Kenny was just talking about And Morley, you were too, essentially the third one, scratching an itch. It's like that sort of thing can be okay within, one's overall wealth or portfolio if it serves a specific purpose, if it's to scratch that itch and makes up a reasonable and rational amount of something. Maybe you've got an affinity for a specific company or stock because
Mhm.
reason. Hey, not to say that you can't own it or
Yeah.
it's always dumb to. It's just that we got to manage it appropriately and within certain confines. Um, the other analogy to scratching the itch is like when somebody wins the lottery. I think there's been things that have come out of this show. Hey, it's actually good to go out and get a little spending spree out of your system and scratch that itch so that you don't just keep spiraling out of control and ultimately lose it all because you never really got it out. Like go ahead and do it, but then the bulk of it we got to be smart with. We got to be reasonable with.
Yeah.
Yeah.
Yeah, they always advise you not to like look at the value of your accounts like every day, right? Or, like just to kind of put them aside and just know that your money's doing its work. Cause it's like when you start looking at them every day and you're seeing some of the volatility and like, then it's like, oh man, like, should I be in the stock? Should I not be in the stock?
100%.
It
I think
becomes
he makes
very
a great point too about loving what you buy. If you love what you buy, you're okay with, um, that's one thing. Just as advisors trying to get somebody to love their investment philosophy, and then our strategy can be tough. But with an individual company, you love what you buy and it goes down, you love it. Like you're likely to wade through it in the bad times. As to where if you're doing something just because it's mathematically the best thing, and it starts not going the way you want, it's much more difficult to stick to.
right. And you might love an individual stock for any number of reasons, with like with one of our clients, they love a stock because it was their grandfather's stock that they had inherited. That stock has meaning to them, eh, totally regardless of what the name of the company is. They couldn't care
Yeah.
less. It's only because it came from their grandfather. Hey, that's okay if we keep it within a certain confines. Or maybe you love, a certain automaker stock because you think he's a mogul and you've got the car in your garage. Okay.
Mhm.
I mean, sure, you've got a personal affinity for it. It's not a bad thing. We just got to make sure that it's reasonable within the overall plan.
Yeah, I'm totally with you. I have my own personal stock picking account that I love to pick stocks. And I mean, but it's also the same thing. It's kind of like it's still a portfolio theory, right? Like, of the 30 stocks I have in there, it's like two stocks that account for, 80% of the return. So again, it's like, it's gambling, right? You're just betting on a couple of things. I mean, I can totally consider investing in stocks like gambling. Like, yeah, you can do research and make sure it's a good company and whatever, but like at the end of the day, right, nothing's guaranteed.
Yeah, nothing's guaranteed. And the cycle that we see on the screen here is what every investor goes through, regardless of what your strategy is.
Hmm.
I would just say, depending on how it's being implemented or what an investor is actually doing, those highs can be higher or those lows can be lower, um, which I think just goes without saying.
One thing, as far as the psychology, and he talks about it in this chapter, looking at your portfolio often. I mean, the reason why you really shouldn't, or is because it's going to make you or entice you to make emotional decisions. Your chance of making money day over day is 50-50. So you looking at your account every day, the chance of you being happy or sad is a coin toss. Every month, is probably a little bit better, but not that much more substantial. Every year, it's still high, right? I think it's 68% of the time or something like that. It's positive, but that's why, because you're going to be unhappy. This year was, and really that's totally in the realm of normal.
Hmm.
And, that's where it's like, if you could go on we've talked about this before, if you could be set away on a deserted island and came back 10 years later and saw what your portfolio was worth, the likelihood of you being just ecstatic is very, very high. I mean, it's just very high because the returns on the market over a 10-year period on average are very good. And even if it's 5% return or whatever, your initial investment is going to be worth close to double what you started with. And most people would say, hey, that's pretty good. And looking at it daily, it's just a coin toss whether you either made or lost money.
Right.
And
Mhm.
it makes it easier to make a rash decision.
Mhm.
Is it a desert island or a deserted island?
Well, it could be, but it could be an arid island if it's not a desert
Yeah.
island.
I'll go with the desert island.
Desert island, yep.
Any other thoughts on chapter 11?
Mm,
Good. Okay.
I mean, I think that's what investing comes down to. Like people, I feel like people think that like the markets and finance, whatever, is like this, this complicated like science. And a lot of the times, right, it's more just human emotion, right? What the markets do each day to me is always just fascinating to see like what news is moving people or spooking people or whatever. That there really isn't a science to a lot of what happens with the markets, right? It's kind of like that's what people feel today. That's what that stock is kind of what people feel that buying and selling. Just a quick story. I do interviews for people applying to go to Emory, and I was interviewing the senior who was applying to Emory, and we were just talking about, what do you like? What do you not, what are you interested in? And he was like, well, I'm trying to learn about the stock market. And I was like, oh, interesting. Why are you trying to learn about the stock market? He's like, because I've learned that money's important and I need to figure out how to use the stock market to make money. And I was like, that's such an interesting concept, to hear like an 18-year-old who probably hasn't been exposed to very much finance, right, through high school, realize that, okay, now I'm graduating, going to college, I got to figure out how to make money. And people seem to be making a lot of money from the stock market. And that's where I need to figure out and do. And I'm like, that just seems so interesting to talk to someone and be like, really? That's where you think all the money comes from, is the stock market? Interesting.
mhm.
He's thinking
I
about.
mean, before people know, have experience investing, they think it's a riddle to be solved.
Mm-hmm.
People with experience think that.
Mm-hmm.
And it doesn't mean you'll lose. I mean, it just doesn't mean, most of the time you're not adding value by thinking in those terms.
Mm-hmm.
You're not really getting a better return. Most of the time we see people, you've taken more risk to ultimately fall back to just where you should have been anyway. And you spent not your human capital worrying and trying to study as if it's some puzzle that you can get. I'll never forget one client that you've seen the charts with the asset classes, this one did this year and this one.
Oh,
this
yeah.
year.
Yeah.
And the point of the chart is that it's to say you don't know what's going to be best the next year, right? Because it was worse this year, it does not mean it's going to be worse next year. And because it was best this year, so that's why you spread your investments out among these multiple asset classes, and you're really assuring yourself of finishing in the top part, over a given period of time. And then this gentleman was just trying to decipher it. Like it was a code that was you were gonna pick, like what is the pattern? What is the trend? What am I? Beautiful mind. Like
Yeah.
no, you're missing that's not the point.
Right.
Yeah. I have to imagine you guys get that all the time. Like, where should I go to get the return? And again, like that's why I like this book, because it's like it doesn't matter what the return is, just stick your money in the market and let the market do what it's going to do. Like who cares like what the returns are? I mean, obviously don't put it in one stock, but
Right.
I mean it does seem like, and especially with like all of these like hedge funds and like now, you've got people trading on options and like everyone's trying to like make it into this like scientific arbitrage opportunity. And it's like, just stick it in there and then just let it do what it's going to do.
Mhm. Because that's human intuition for most everything else, is if I do more, or if I know more, or if I can solve the riddle, then I win. And it's understandable, because this is a beast that is, pretty much the opposite of that.
Mm-hmm.
The thing that we deal with, a lot, and it's just, I mean, most people think this way, is they'll look at their 401k statement and they'll look what they've received, how their performance has been, and they'll state, well, I'm getting a 12% return from my 401k. I'm getting this. That's not what you're getting. It's what you've already received, and that tells you nothing about what's going to happen in the next 6 months. Because if we could just buy something that was going to give us a X, you return 10, 12, whatever, we just go buy that and have, sit on the sidelines and watch it grow at a pretty rapid rate. And that's where just that, and I think that if you were to poll, that's the average mindset of of Americans. Like, they think that that's what it is. I'm going to continue to get this, even though it's unpredictable. And the only reason you got that good return previously was because of the unpredictability of it. If it was, it wouldn't be that. As we see today, I mean, Germans' interest rates are negative, right? You have to pay them to hold your money for you. In the US, you can still get whatever it is, next to zero. That's what you get if you want no risk, no uncertainty. Guaranteed certainty, guaranteed your money, you get guaranteed in today's environment zero, which is really negative because inflation is more than you're going to be earning.
Right, exactly.
Yep.
Hmm.
Well, this was a good one. I covered a lot of ground today. Yeah. So next time we will get to chapters 12 and 13.
All right, sounds good.